Welcome to FM Radio, your go-to podcast for everything in the world of funds management. Whether you're an experienced advisor, a seasoned investor, or just starting your journey, we're here to break down the complex world of funds management, all in a way that makes sense. Each episode, we'll talk to the experts to get their insights on everything from asset allocation to risk management and give you the inside track on how decisions are made. Today, we're joined by Alastair Macleod, one of the portfolio managers at Elston. And Al is here to talk to us about an article that he wrote for Livewire just recently that has generated quite a lot of interest. Good morning, Al. How are you?
Good, thanks, Pete.
So, Al, this article you wrote, I won't say it went viral. I don't think anything on LinkedIn ever hits those lofty heights. But somehow, when so many people seem to be talking more about the CEO and his HR manager on Kiss Cam at Coldplay, everyone else was talking about the article that you wrote titled, Why My Mum Might Help Pop the CBA Bubble. Why do you think it drew such a strong audience?
Yeah, look, I think it's running well. I think the reason is that CBA, the share price has pretty much gone bananas, but the earnings haven't changed. And, the common argument is that it's passive, so the growth of ETFs and whatnot. But if you look at the second largest share on the ASX, BHP, it's actually down 20%. So that argument that it's passive flows pushing CBA ever higher just never held water. Like, it doesn't make sense. So I was trying to work it out, and then it was actually, I was talking to my mum, and actually she gave me a clue.
So your mum's actually the financial genius. She worked it out for you.
She's an old bookkeeper, so she definitely knows her P&L.
So if you think about your mum, and I guess I sort of picture you guys sitting on the veranda having a cup of tea and a pencil and paper, and as you said, being would you say an old bookkeeper, so
Yeah.
she loves columns of figures and working it out. When would she have first bought some CBA shares?
So, yeah, she didn't buy them in the IPO, but she bought them in 94. I think she paid $9.45, and she still got the check butt. And a contract note when she bought them.
It sounds like a good price.
Yeah, it sounds like, well, given it's yielding, $4.75 annually today, that's a pretty good return on your capital over that period.
Yeah.
And obviously the share price now, well, it got to 190 thereabouts, about 175. So huge capital growth over that period as well. And yeah, over that period, she bought a few more, but she never ever sold any. And, I think that's really important to understand that for a lot of those mum and dad investors, they still own a lot or all of the shares that they bought on their journey.
Which I guess you think about, I think you referred to it as absurd valuation, the valuation of CBA, and it's crazy. But when you bring back to human behaviour, your mum and lots of other mums and dads like her, it's just their behaviour and their natural bent to buy a solid share and to hold on to it for decades.
Yeah, well, that's exactly right. And I think, you mentioned valuations. So, the CBA share price has gone up, phenomenally. It's gone up a lot, been very strong. But the underlying earnings haven't grown by anything like as much. So in a share price, there's only two ingredients. There's earnings and there's the valuation that you put on those earnings. If the earnings haven't grown that much, then the only possible other thing that could have changed is the valuation. And that's exactly what's happened with CBA. And it is now the most expensive bank on almost any metric on the planet. It's double or three times worth what an equivalent bank in America or Europe is worth. So, I think, sometimes in investing, it's difficult to know exactly what a share is worth to the dollar, to the cent. But there are definitely times when you can go, well, actually, that is very expensive or that is very cheap at extremes. And this is clearly one of those times.
So we can't put it all on your mum. Your mum didn't do everything, but you talk about the price momentum. In the article you refer to a price momentum. What do you mean when you talk about price momentum?
Yeah, so momentum is a characteristic of professional investors would call it a factor. And there are other factors like quality shares, academically have proven to outperform and value shares. So shares at a cheaper price have typically outperformed. And the other characteristic, which is pretty different to those, is momentum. Now, momentum simply means if a share price or a commodity price or whatever has been going up, then there's a behavioral impulse as humans, and people will buy those securities or assets, and it's been proven that they actually can generate outperformance. But the only reason is that they're buying them because they're going up. Now, they won't always go up, but they typically move in regimes or trends, and that's what that momentum investor is trying to capture. So momentum investors would have seen that the share price from CBA is going up. They would not know necessarily what even CBA does or care, what the valuation is or care. They just see the share price going up, and that would be the reason why they would buy it. And that started happening around December 2023, which is about the same time when the valuation became really unhinged and untethered from fundamentals. When we look at banks, we typically value them on what we call a price to book. A book is their assets. Their loans that they have lent out are their assets. So, typically in Australia, banks will trade at 1.5, 2 times price to book. That's at the upper bound. Now, CBA being a premier bank or premium bank, at about 2.5 times book, most rational investors would be going, this is pretty expensive, and there's probably not a lot of upside here from a valuation perspective, and they'll start to sell the share. Now, what happened from December 23 is that as the price kept going higher, from 2.5 to 3 to 3.5 to 4 times book, which is where it is now, any rational investor, and most professional investors have a valuation yardstick, like they're looking to buy, they're aware of valuation, and they clearly know what the business does. And it's almost impossible to make a valuation case that the CBA shares are cheap at 4 times book. So progressively, professional investors or active investors have sold their shares and exited the register because there's just no fundamental reason to own it. And that's evident in Zenith Research House when they're running the numbers. About 90% of active managers are either don't own any CBA or are underweight CBA. Underweight means you don't own as much as what's in the. So it's been unpopular at the moment. It's not. No one owns it from a professional investor perspective.
And even though you're saying that some of the active managers have decided to pull back their weightings, they're stepping back and waiting for something to happen, the price is still pretty firm.
Well, yeah, and that's where I think passive plays a role here, but it's not the role. It's really that how different that share register looks at the moment. So a share register is the ownership of that company or that share. What does it look like? And that's what's really unique about CBA, because all of the banks actually have a very high component of retail investors. Now, retail, you might have bought it on the IPO. Again, like my mum, you bought it, you never sold it. So at CBA, it's about 47% of the register, nearly half. And the major banks, they range from 40 to 47, but all of them have got a very high component of retail investors on the register. Now, numbers from Barrenjoey suggest that retail's 47% at CBA, but because active managers have been selling, they're only about 8% of the register. So a very small fraction of that total register, with the balance being held by either passive. So passive is when you buy an ETF and you just get what you get, the 12% of CBA in the index, that's what you own. And increasingly, large superannuation funds, which they have this My Super rules, where they get penalised for not being close to the index. It encourages them to have a portfolio that looks like the index. So we call them quasi-passive or benchmark huggers, whatever you want to call it. So they're about 45%. So benchmark huggers and passive, 45%, retail, 47%. That only leaves 8% of rational investors who are price sensitive, who are valuation sensitive, that when the price is at those levels will want to sell, but they're not there anymore. So what it means is you've got 92% of the register, which doesn't really care about price. And when we get an inflow into an ETF, and look, passive is growing, there's secular growth happening in passive. When we get $100 coming into an ETF, because CBA is 12% of the index, $12 of that 100 will be trying to buy a CBA share. But if you think about it, there's only 8% of that $12, so $1 that's actually available to buy. So in any share price, it's supply and demand. If you've only got $1 of available liquidity and you've got $12 trying to buy it, the only thing that can move is price. And that's exactly what's going on. But just as that's going on, the momentum investors are saying, hey, that share price is going up. We're going to buy that too.
Yeah, so you've got momentum moving things forward, and then you've got this price squeeze because there's scarcity in the market. It's a crazy situation, but like you mentioned before, it's a very unique situation with CBA. But if you compare it to other, the big players in the ASX, we talk about BHP, they don't behave in quite the same way. And is it just what you're talking about? It's the underlying factors are quite different to the way that the market is interacting with BHP.
Yeah, so that's exactly right. So it's not just passive or passive. It's passive plus a very tight and unusual register, which is causing the share price to. Because if you consider BHP, the register looks completely different. Now, there's a number of reasons for that, from the IPO to the merger with Billiton to the dual listing. But the active share or the rational investor component of the BHP register, and according to Barrenjoey on this, is about 45%.
Oh, yes, that's a massive difference. 45, you're saying 45 versus 8.
Versus 8.
Yeah.
So if you think about it, again, using the inflows into an ETF, BHP is about 7% of the index, a bit over. $7 will be looking to buy CBA, but for nearly half the register is available to be sold. So it's trying to find, $3 worth of liquidity. So the price squeeze is nothing like as dramatic, and the availability of marginal sellers is vastly different. And I think the evidence of that, there's two evidences of that. One is that when you look at the main commodity produced by BHP is iron ore. So if you look at the iron ore price over the last 18 months, it's down about 20%, and BHP's price is down about 20%. So it's trading on fundamentals. It's trading on the prospects for that company to earn a profit, and the share price is reflecting that. And I think that the other evidence with BHP, and in fact all of the other the other banks, is that when you look at the liquidity going through the market, so as a percentage of the size of the company, the market capitalisation, for CBA, it can be as much as half as much as the liquidity in those other names. So
it just doesn't have the turnover.
It just doesn't have the relative to the size of the company.
So you're talking about the fact that there's not a lot of people wanting to sell their shares, that you've got a large group of sticky investors. How do you actually then, when you're sitting down with your cup of tea with your mum, how do you get to start that conversation where you say, maybe now's the time that you should be thinking about, not necessarily bursting the bubble because it's only your mum, one out of millions of people, but how do you get to the point where you say, I think there's a reason here for someone to move their position and actually think about selling their CBA shares?
Yeah, well, I think, again, everyone's got their own circumstances, but mum's in retirement. So a lot of people who are in retirement, they're relying on the income that their investments produce to pay the bills. And when we look, would speak about her portfolio, like her banking shares have done very well. So it's not surprising that, from a risk perspective, they're a large part of her share portfolio. Now, that sort of concentration from a risk is not great from a risk perspective to have a lot of your exposure in one company or one sector. So whenever we looked at the portfolio, it would be like, well, it'd be good to diversify, but because you've owned them from such a low price and, they weren't held in super, so they're held outside of, there's obviously capital gains tax. If we were to sell those, pay the capital gains tax, the impact on the capital base would impair her income. So there's nothing we could buy that would replace that lost income producing capacity, because CBA always used to be a very high yielding share from an income perspective. So her income would be impaired and the capital base would shrink, but things change. And, sometimes never is not a very long time. And, with the share price rally, now the goalposts have moved when you do that. So, and we sort of ran a scenario that even if you had bought your CBA shares at $5.40 in the IPO in 91, so almost all of the share price is gained. It's almost 100% capital gain. And even if you were paying the top marginal rate at 47% and you paid the tax and you just bought the market, your income would be pretty much unchanged.
So when you say buy the market, like buy a range of stocks.
By the ASX 200
Yep.
in an ETF, in passive,
Okay.
where CBA is only 12%, but you're massively diversifying from one expensive stock to a basket of 200. So your risk on any metric improves. Your income would be about the same. Now, that's an extreme example because there's no one who's got a gain bigger than that, and there's no one can have a tax rate higher than that. So in any other variation where you bought it not in the IPO, or your tax rate is less than 47%,
It still looks good.
You might be in your super and you might be in pension or where your tax rate's much more favourable. Then in any other scenario, exiting your CBA shares to buy the market, you will increase your yield and decrease your risk, which you've never had this opportunity before. And, in investing, it's a win. You don't get win-win situations very often. And the ability to increase your yield while at the same time, and you pay the tax, reduce your risk.
Yeah, but the diversification is fantastic. I mean, an amazing benefit. But do you think many advisors have connected those dots and are having those discussions with someone like your mum?
Well, I think, I call mum and, they're rusted on investors and CBA has been good to them and they want to be good to CBA. And I think all that makes sense. But I think we've never been in this situation before where, when you do run the numbers, you go, well, actually, there is an opportunity here to, and maybe you don't sell, maybe they don't sell all of them, just sell some. But if you think about it, this is a margin, this is a seller, this retail block at 47, even if some start selling, then it releases the pressure valve. It means that $12 coming in, well, now there's some marginal sellers. Maybe the share price doesn't go up as much as the market. And then the momentum investors say, the share price isn't going up. We're going to start selling that. So you have one marginal seller expands to two, and that's when it starts unwinding. And then, from a fundamental investor's perspective, you're not even thinking about getting interested in this thing till it's down to 2.5 times book. So there's no fundamental buying support. It's kind of like an air pocket. And you just need one or two little cracks to start emerging. And then there is free fall until fundamental investors actually want to get back involved.
I think it just sounds fantastic. For your mum to be able to, as you said, enhance her income or at least match the income that she's getting currently, and then to end up with more diversification in her portfolio makes a hell of a lot of sense. And I guess if more retail investors start to think the same way, that the bubble could burst, or as you said, at least the momentum could slow and perhaps even start to reverse in the other direction would be pretty good. So, look, it sounds like you're going to need to sit down with everyone's mum and have a cuppa and explain the possible benefits. So I won't hold you up. You've got lots of mums to visit. So thanks for coming in today, Al. It was a fantastic discussion.
Thanks, Peter.
That's all for this episode of FM Radio. We hope you can join us again soon as we tune into another aspect of funds management that affects you and your clients. In closing, I'd just like to say that Elston acknowledges the traditional owners of country throughout Australia and acknowledges their continuing connection to land, waters and community. We pay our respects to the people, the cultures and the elders, past, present and emerging. FM Radio was recorded at the Pod at Cutting Edge Studios West End. It was hosted by Peter Goodall, and today's guests were Elston multi-asset portfolio managers Alastair Macleod. For more FM radio episodes and full transcripts of the interviews, visit elston.com.au. And if you'd like to subscribe to our podcast series to make sure you don't miss a thing, you'll find FM Radio on your favourite platforms, including Spotify, Apple and Google Podcasts. The information provided in this podcast is general in nature. You must consider your own circumstances prior to making any investment. For more information, go to elston.com.au or speak to your financial advisor. Elston Asset Management is authorised by EP Financial Services, AFSL number 325252.